There has been much investment into tech stocks. An embrace of the unknown has become normal today. Unknowns such as, will the company ever be profitable? What exactly does this company really do anyway? Will this business model even make sense next year? But I guess the real question is, who cares, right? I mean, the Fed would never let it fall anyway. They love us. They love us so much they met in secret in 1913, colluded with politicians to pass a law allowing them to overtake the financial system, and now won't even allow their criminality to ever be audited, and even the suggestion of it is laughed off. Good stuff. You came here for the truth, so let me unveil that for you. Just a little bit of truth to start the video. Nobody wants to talk about that. That's not cool, not popular, not trendy. I get it, I know. So let's talk about some snowflakes today. We're going to talk about unicorns, we'll talk about rainbows and kittens, all of which are really important to the financial system today. They make a lot more sense than any of the indicators, which I'm going to give you and show you how we are at 100% and the 100 percentile for 11 different indicators, very important indicators historically, and now today everything is simply falling apart in that regard. Nothing makes sense, and when we get to these points, people have to start asking questions. San Francisco's 35% plunge in rents shows effects of tech fleeing the city. It's not just this one area. We are also seeing, I think it was Goldman Sachs, who's planning on leaving New York, going to Florida. I am seeing huge migration coming out of places like California, out of New York, moving over to Arizona, moving to Texas, moving to Florida, and some other places. They're looking for lower taxation. They're looking for lower expenditures in general. But you see all the time, what are the solutions? Increasing taxation. I've said that before. Remember that? Many times, in fact. But San Francisco is just one extreme place because the prices of the homes are so excessive. I was looking at rents there over $3,000 in previous videos. New York had rents going over $4,000 at one point. I mean, depends on the area. Of course, you see lower ones and higher ones and so on. But this is one area that's so extreme because the tech stocks, because of what has happened. Now, those tech stocks have led the charge as you see it in the actual markets. But what's happening with the real estate side of it? Well, clearly not really good, especially in the areas that they talk about where you are seeing this decimation, particularly in the downtown areas. And the same thing applies to areas like Toronto, which we'll also cover today. This is an article out of the San Francisco Gate and it's talking about the actual businesses and what they've been suffering with this period. It's just been, in their words, decimated. Take a look at this. To describe these former bustling neighborhoods as decimated wouldn't be a far stretch either, based on credit card usage data gathered by MasterCard and shared with the San Francisco Chamber of Commerce. I'm going to show you this. Check it out. About 293 of 344, or 85% of bars and restaurants are presumed closed throughout South Market and Financial District and their adjoining neighborhoods. And that to me shows how extreme this can be for this particular city. And you go out further, same kind of situation everywhere. Maybe it's not 85%, maybe it's 70%, maybe it's 60%. Either way, there are so many people that are just being hit so hard for different reasons. And I think the trend is really going to change a lot because you're going to have people that are going to be more comfortable. Number one, maybe preparing their own food at home or just doing takeout, or they're going to do ordering in. They're going to buy, these monthly passes and they'll get themselves a way to bring the food at home. And it's gone on so long that it's become habitual for so many. I don't necessarily think that's the case for everywhere. And certainly next year, some restaurants may be fully open and they'll be dealing with their own circumstances. But I think just right now, it's just completely pandemonium for so many. I told you I would talk about unicorns, so check this out. Welcome DoorDash and Airbnb, the $100 billion duo. In a hot market for new tech issues, the two companies have earned a place at the top of investors' lists through growth and grit. I joked about it in the introduction, but when you have a company that says, we're not even sure if we can become profitable. Think about how crazy that is. If they said and they lied to you like they all do, we're going to be profitable. We can't right now, but we're going to scale. We're going to figure out a way to revolutionize the process. We're going to institute this, this, and this, and then we will become profitable. It'll take 5 years. It'll take 10 years, whatever that is. Investors can see that and think to themselves, okay, I'll hang on. There'll be some ups and downs, but eventually, we'll get there and I'll make a profit, so on. But that's not what they're saying. They're saying we can't even necessarily be profitable in what we're doing. And investors just poured so much money into it. Airbnb, DoorDash, look at how many different IPOs. I'll show you the index in just a second. But how many IPOs have seen this huge surge of cash just flowing in? And it shows you that people right now want to get in on the next Amazon. They want to buy the next, all of these high-flying stocks. And that's quite different from what we've seen in previous years. 2020 is unique in that aspect. Here is the Renaissance US IPO index performance. Everybody who was buying Amazon stock, you were wrong. If you bought Apple stock, you were wrong. If you bought into any of these FANG stocks, you were wrong. You should have bought the IPOs because the IPOs did better than you. Do you understand that? You should have bought the IPOs. Anything with the word unicorn in it, you should have bought it. If it had a kitten somewhere in their pictures, in the media that they use, you should have bought it. It was furry. Did you see that? Did you see the furriness? No, you didn't, because you were buying Amazon stock. Look, I got 7 shares. I know what I'm doing. I could tell you. But in this case here, the IPO index clearly states that these particular stocks have seen an influx of money, definitely since the bottom March of 2020. There's no doubt about it. All right, I'm going to try to come back to earth here. This is just so extreme. There's no company this year that has been more extreme than Tesla. Tesla trading at $650 gets $90 price target from JP Morgan. I thought it was quite unique for them to come out at this point when everybody is saying buy for the most part, even though it is the most shorted stock. At the bottom here, they're saying Brinkman says that Tesla shares are in our view and by virtually every conventional metric not only overvalued, but dramatically so, citing the stock price that trades at 1,300 times its long-term PE multiple and 291 times its 2020 estimate. Many people say that these statistics do not matter, these indicators do not matter, and technically, they don't matter. They're measuring sticks. That's all they are. It's to see how it is in history, to see looking out into the future, and that's how these analysts measure things. But today, what people are concerned about is how much money I can make from this. I am putting my money in today. I am going to make a certain amount based on whatever chart analysis that they've done and they found on Seeking Alpha that they believe it's going to go to a certain place and it's never going to come down because the Federal Reserve will be there to backstop any losses. I don't know if that's the case because the Federal Reserve hates your damn guts. This comes from Crescat, and you could see the S&P 500 valuations, right-hand side, historical percentile. That's 11 of them that I counted that are at 100%, and the remainder there are above 90%. So take your pick. It doesn't matter. On all of these levels, we are at the highest valuations ever. Okay? That's ever. And that just shows you how extreme we have gone. And does it surprise you that we've seen the most extreme actions from the central banks, from the Treasury, from every angle, in fact? And that's just so terrible in so many ways, but people love it. Yes, the rich got richer. Top 1% saw their wages soar by 160% since 1979, 6 times the increase of the bottom 90% of workers. The stats are huge. You can see right here, I know the font is small, but I just want to just cover everything here because it's really telling to look at what has been happening over the past few decades. The rich aren't just getting richer, they're getting there faster than the rest of America's workers. During the last economic expansion, 2009-2019, average yearly wages for the bottom 90% of workers rose 8.7% after adjusting for inflation, fake inflation. All right. And then meanwhile, the pay for the most of the top 10% rose 13.2%, while earnings for the top 1% jumped 20.4%. This is a clear story of disempowerment of workers. At the bottom, they just talk about the different compensation packages that, these top finance companies are given their executives and so on. They're able to get stock. If the stock's getting pumped up by the share buybacks, then they're going to clearly win. And that's just the way it is. Toronto's languishing condos put mom and pop investors in a bind. Essentially, what we're looking at here in this example is they show at the top where you've got people, 2018, they were buying pre-construction condos. The market's going up. It's rising. They're thinking to themselves, okay, I'm going to put down this minimum payment. I'm going to get in and I'll get a renter in there and it will eventually be a great investment. But you see a whole bunch of people that didn't want these homes. The condo glut has been increasing. I believe they show a chart further down, but you see the amount of condos, the inventory has been picking up in this city as well as other cities, and more people have been buying into detached homes, semi-detached homes, whatever they can get their hands on. They want more land, they want more bedrooms and so on. And as a result, people that own these condos are left with either vacancy or they had to drop their price down significantly. And in this case, they're showing how people are simply in their negative cash flow. They're underwater. This was pretty obvious, but the Bank of Canada stood pat on interest rates and reiterated its commitment to keep them at historic lows until the recovery is complete. They're doing the same thing as all the other central banks out there. You got their rate at 0.25%. That's roughly where most central banks are. And I noticed that, when you take the amount that the central bank is pumping into the system, $4 billion, that would be equivalent to 3.1 US dollar every single week. Look at that in comparison to the size of the actual financial system in Canada. It's a huge number. It really is. So that just gives you an idea of how much money they are trying to inject in, and interest rates are at these lows. It is sending people into a frenzy. Where can I put my money to get that yield? They're doing so right now in real estate, but of course that's also being felt in tech stocks specifically, but the wider market as a whole has been seeing the benefit of all this insanity. As expected, I said this was coming. I've shown you examples of how they've been doing this. It doesn't surprise me. I know it doesn't surprise you. New York needs to raise taxes, Andrew Cuomo says. Of course they have to. They increase the taxation every chance they get. Every time something happens, big or small, they increase the taxes. Where is that going to come from? They haven't decided yet. It could be property taxes. It could be on your income taxes. It could come from any direction, but you know that they're going to do it. Billionaire shocked by son's quick $50 million trading loss. I just show this because people take such big risks. They don't know what they're doing. They haven't done the research. They haven't had the planning or the training or any experience, but they've seen the market go up and they feel great about it. And just learn from the lessons of others. Be cautious. Hedge your bets. Do you know what hedging your bets are? I assure you that too many people that have been pumping their money in unfortunately don't, and that's quite unfortunate. I know if you watch my videos, especially if you got to this part of the video, you know exactly what I'm talking about. So thank you very much for being one of the very few that actually makes it to this point in the video and on all my content, because look, let's face it, the views are going down, subscribers have gone down, we're not going to get the big views. That's it, and I'm comfortable with that, and it doesn't matter to me necessarily, because I want to know that people are getting the information that they need. And if the other people out there don't want it, well, that's okay. I'm happy that you're here. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting my channel, so I want to thank you for that. If you want to learn about e-commerce, you're interested in making money online, you can do so at the amazongps.com. If you want to learn about the financial system, everything you need to know is in these 2 books. You can check them out at the link in the description, and you can get the audiobook version at themoneygps.com. But wait a second, have you seen this video yet? If not, you definitely want to check it out. So do that by clicking here, and I'll see you there.